Welcome back to the LSCRE podcast. Super excited to have a great guest today. Someone Bernard, I've seen you at conferences for, almost half a decade now, making the rounds in the similar rooms, shaking hands, kissing babies, and doing the equity raising dance. So you and I know similar pains and struggles in many respects. However, we're going to talk about something different than what we talk about at Lone Star Capital or LSCRE, what you do at EHP Capital. Bernard Pierson is the guest today. He's the managing partner and co-founder of the company, EHP Capital. How are you?
Good. How are you, Craig? Thanks for having me.
Yeah, excited to have you on and excited to see you at the Summit event in about a week from now. So super fun. Always kind of nice to see similar faces and have that continuity with people that you're looking to raise equity from. So we're super excited to host that event. And if you're looking for a last minute ticket, perhaps one could be available for you. Go to our website to see the summit. But with that said, Bernard, we would love to learn about your story, kind of your background, how you got to where you are today, and kind of your focus in the market.
Yeah, so I'll start by saying I'm also very excited, and me and my partner are going to be there at the events. We're very excited to be there, and it's a great event. We've been there before, and you guys do a great job. So thanks for putting that on, and for bringing so much value to all of us. And we are very excited to be there in a couple of weeks. So about us, so we are. We founded, me and my partner founded EHP Capital like 3-4 years ago. We both have been in multifamily for a lot longer than that, but we merged our companies, and that was where EHP Capital was born. And what we do is we buy multifamily, value-add multifamily in the Midwest. But we specifically are pretty much focused in Kansas City right now, and other parts of maybe Kansas and Missouri, and other secondary and tertiary markets in those two states. We do own assets in other parts of the country, but right now we're pretty much focused, just like you guys are with Houston. We are very focused in Kansas City and have seen a lot of the benefits of focusing on the market.
Yeah, and I think the focus from a acquisitions perspective, really knowing what a good deal looks like, really knowing what is in your buy box, really knowing what deals make sense and what deals don't, per a unit basis. From an economies of scale perspective, those efficiencies are nice. But overall, just managing in one specific area really does save a lot of kind of energy and potential headache. I mean, going into a new market, you learn different things about, how you underwrite, and it's hard to do this business to start with. It's really hard if you're not focused in a specific area. And when you're talking to capital partners and people who you're looking to raise money from, it's a lot easier to sell that you're the expert at one thing. So when they look at their bucket of allocation, they can work with you for that specific need there, if you will.
Right. Yeah, I couldn't agree more. So most of our partners, investors, are family offices from Latin America, and there are multiple sponsors or operators out there, right? But they're looking for the different one, that one differentiator that they can invest with and feel comfortable, and definitely that focus is one thing that adds a ton of value, and we're also vertically integrated just like you guys, and that also has helped us tremendously, and to get to know our market even better, more than we do, and my partner lives there full time, and he's from there, so he also has that local field knowledge, and I feel that we can, through that focus, we can really deliver a lot more value than we otherwise could to our investor base and
Yeah, I
partners.
mean, that makes a lot of sense too, because just the more you think about this, if you're an investor, if you're looking at, call it 10 deals from an operator in a certain area, or 5 deals, right? And one of them, let's just say there's only one that's vertically integrated or two that's vertically integrated. Well, and that means they probably have economies of scale, they have efficiency, they've been there, they've done that, they know the headcount, and they can do these things for a lot more efficiently than third party managing on. And when these deals are so razor thin and everyone's basically paying the highest price to make a deal, sometimes the way these deals ultimately really work is if you've got really good, smart debt on it, but also if you've got that cost saving efficiencies, because sometimes that's the difference between a deal cash flowing or not. So being focused there for, those investors out there, you want to work with people like Bernard or people like us at LSCRE just to make sure that we can ultimately bring the most value possible and be efficient with dollars, because different people are getting different results out here. But speaking of the market there, and you've chose multifamily and you've chose Kansas City in the Midwest. So for those who maybe are uninformed, or maybe West or East Coast people that are living in those areas and don't really think much about the Midwest, what is kind of the pitch and the idea and the thesis behind where you are, which is, ultimately said the Kansas City and some surrounding areas?
Yeah, so I'll start by saying I think that there is no perfect market. I think all markets are great, or not all, but there are many great markets, and they can be great for different reasons. I think for us, Kansas City is a great fit, and I think that it is a great fit for a lot of our investors and partners in their diversification plan. We're not investment advisors, so we don't give them any investment advice, but we would never tell our investors to only invest with us in Kansas City. We really believe that if it were our money, we would probably be diversifying as well as investors. So we believe that Kansas City, or we know that Kansas City really plays a big role, I guess, in that diversification, geographic, if you will. It's much more of a stable market. The Midwest has always been more stable. Rent growth is not going to be as dramatic, but you also won't have as much supply, I guess, coming online as you do in the bigger gateway markets or sexier markets like Miami, Nashville, the Austins of the world. So we really are insulated to a certain degree from that effect. That comes at an expense, right? That we're not going to get the 18 or almost 20% rent growth that I live in Miami that we were getting down here when a couple of years ago. So today in Kansas City is consistently probably in the top 5 rent growth markets in the U.S. for the last 2-3 years, and it continues to perform. Depending on who you ask, whether it's Yardi, RealPage, CoStar, I mean, they all have, their numbers vary a little, but we're always going to be, as a city, in the last 2-3 years, in the top 5, and in many cases, the top growing market in terms of rent in the U.S., right? So right now, we believe it's a great time to invest in Kansas City, and it's definitely an economy that's been diversifying over the years. There's healthcare, there's tech, there's I'll give you an example. Panasonic is opening a huge car battery plant that they invested I think it's either $2 or $4 billion, and they just announced another like a data center. It's not a data center, but it's like a tech hub that Google had announced that they're also doing the data center. It's like another $2 billion, but this tech hub is $10 billion. So that was just announced by the city. So we're excited about all this diversification of this economy and it's also a lot more affordable than a lot of these other more expensive markets. And I'll pick on Miami again. I think it's a great city. I live here. If not, I wouldn't live here. But affordability is not one of its strengths.
Yeah, no, I hear all those things you're saying, and similar to KC, Houston's kind of had the kind of different kind of situations there, but Houston's been notorious as a boomer bust oil and gas city, which the nature of that history is fair. However, the current actuality of that and the stigma is not fair anymore because it has diversified, much like you mentioned, Kansas City's like that. Similarly, Kansas or Houston, where it's our flagship market, we obviously want to buy deals in other markets. Supply is a lot more tame there than the other major Texas markets, which is difficult. Which brings me to Kansas City. You're not going to get as much supply going on in a market like that at times. I'm sure there is units being built in select pockets. You can kind of forecast that for your acquisitions. Similar to what we're seeing in Houston, there is, or I guess differently maybe perhaps, but there was supply that came online, and we've kind of shifted our business models to really not do for our value add, to do traditional value add, which is paint, cabinets, flooring, stuff like that. We've been doing more of tax exemption, extra income routes, things like that, where there's inefficiencies maybe on the management level. That's how we've been creating value recently. But in a market where there's not as much supply online, how is value created for the deals you're looking at? When you've been looking at deals for the last couple of years, how have you been able to make numbers work? How you've been able to make yield happen, things of that nature to, get your deals done and, to sell them to investors to get on board with the business plan.
Yeah, so you bring up a great point, right? We all think about value add on that we have to go and remodel the property and pour a bunch of capex into a property, and sometimes that may be the case, in certain markets or certain environments that may be one of the better ways to find value, but it's not. But it's not the only way, right? We ourselves definitely focus a lot on the operational side of value add. A lot of the properties we acquire are many times maybe owned by an outside investor who has been using third-party property management. There are good third-party property managers in KC. Now, with that said, there aren't a ton, right? So there are, in our opinion, some property managers or third-party property managers who have maybe neglected the property to a certain degree, just to keep it light. And our value add, a lot of it is coming in, and we're vertically integrated. We manage it ourselves, and we're the owners, and we treat the property as an owner. And many times that's just what it is, right? Like we just bought a property recently that is just pretty much off a main highway in Kansas City, and there is the sign to the property is off the highway, right? So there's a ton of marketing that you get, or a ton of leads that you get from the leasing side from that sign, right? And well, it turns out that number wasn't going anywhere, right? So all these leads were getting lost, and ownership probably didn't know about it. I suspect the property manager probably didn't really care about it. Potentially, I suppose, because otherwise, it would have worked. But long story short, the number didn't work. We bought it, closed, took over, and there were like 200 voicemails on this number that nobody was checking, and it was all these leads. So that's one small example of things that, or opportunities that are left on the table that we're definitely looking for and monetizing and adding value by operations. Operations is huge, especially in this environment. We're seeing that, our residents appreciate the improvements, but it's almost like they appreciate a lower rent more.
Yeah, I would imagine that. Yeah, no, it does, because in this day too, when rents are kind of being slashed in a lot of places, when rents are, effectively with new supply coming online and, affordability being where it's at, the lower the number will probably keep your tenant happy there. So when you think about these business plans that have a ton of, I guess, CapEx involved with them, where you got to spend about 10 grand, 15 grand a unit, you may not get a $200 rent bump. Tenants might be tapped out with kind of where the economy is at right now. So optimizing on getting occupancy there and getting, your rent good, and maybe finding some little ancillary income items you can hit people with, as opposed to, base case at 1,500. Like, we want to buy deals where, in-place rents is like, and pro forma rent are just a little bit away. We're not going to compete on the highest rent. We just want to add our value proposition, which is probably managing better, lower payroll, stuff like that. And then if we can get a force multiplier into the effect, we'll take that. But that's a good point. And I think another point here that's so funny that you mentioned is, at the end of the day, these are human businesses, and humans get things wrong, and bad management really affects things. And the effect of, the lack thereof of care to make sure that such a key thing like a phone number was there is solid. But you think you get into these deals and stuff like this doesn't happen, but stuff like this does happen all the time. It's funny. We always say too, the most important person on property or in a business plan is really who's in the leasing office and who's pushing that product and getting it done, and tenant satisfaction. I mean, if you've got a great closer in that leasing office, that is the difference between being, 92% occupied or 80% occupied, unfortunately. So things like that are really important. I mean, from a hiring perspective, have you seen that when you kind of take over properties, and, how do you manage the, kind of onboarding process, and, maybe keeping some people on or kicking employees off from the takeover process?
Yeah. So we most of the time we interview, if not always, the current staff, because there are a lot of times some good team members, right, or potential team members that we see on the properties we acquire or we identify. So we interview them, and a lot of the times we do hire them if they fit our culture, if they fit our company, our values, and if we think they're a good fit for the position. We've especially we see that a lot on the maintenance side, where they are familiar with the property already, they know it pretty well, and it really can help if they're a good fit, right? It can really help with the familiarizing yourself with the property, because maybe this maintenance person has been at the property for some time, or the maintenance supervisor has been there for, I don't know, 5 years or 10 years or sometimes more. and sometimes they're a great fit. So when we recruit, we definitely consider the current staff, or always talk to them at a minimum. It also helps with the staff not getting nervous that the property's getting sold and now everyone's going to be jobless. I mean, that's not what we necessarily want to convey when we take over a property. So there's benefits to that too. And other times we bring team members from other properties to help us supplement that. Maybe another property is already more stable, and maybe we have somebody who's more specialized in the earlier parts of a transition and whatnot. So we bring in team members that help out with the transition from other properties as well. And sometimes we hire, right?
Yeah. So when you guys are looking at deals, switching over to kind of fundamentals acquisitions, what are you guys typically solving for with regard to kind of return structures and stuff like that on a typical base case perspective, and things of that nature, like from a cash flow? Because it's always funny to hear apples to apples comparison, from multifamily, if you're going to buy in Texas, the Midwest, West Coast, East Coast, so on and so forth. So be curious to hear what, a typical breakdown would be from a cash flow and an overall, IRR perspective, if you don't mind sharing from what you're saying.
Yeah, so I'll start with a big, boring, it depends, right?
Yes.
But
caveated.
It's going to depend a lot. But however, that said, we do target deals where we feel we can deliver high teen returns in terms of IRR to our investors, 17, 18. We're not really looking for that 25% IRR. I mean, it can happen, but and there are deals that maybe we underwrite and they give us that number, but I will tell you that it's not common. And I've LP'd a lot, so, and maybe I'm going off topic a little here, and I've been an LP multiple times, with my own money as a retail investor, and I see very little relationship in the deals I've invested in the last. I mean, I probably did my first LP deal in 2012 or something, and I see very little relationship on the advertised IRR and the realized IRR on the deals I've invested in. In fact, there may be an inverse correlation, if anything. Like all those deals that were advertising 30 IRR, and maybe not all, because there are exceptions, a lot of them ended up underperforming a lot. And in my personal portfolio of LP investments, right? And the lower, for the most part, the lower ones, the ones that were more 15% kind of thing, more down the fairway deal, those were the ones that a lot of the times ended up outperforming and delivering those 30% or 35, 40% IRRs that were very nice to have as an LP. So going back to our deals, we target those high teens, 15 to maybe 19 IRR. We definitely try to solve for 17 and a half-ish kind of IRR, depending on the deal. For the LP, we have different classes of investors, so it may vary from investor to investor a little. Our cash on cash is typically, I want to say, this one depends a lot on the deal. Depends on the financing you're using, if you're assuming debt or not. Like in this environment, but we're typically looking at on average cash on cash of at least 5%. And into maybe 7-8% once it's stabilized. And we've seen that for many of our investors, the equity multiple is important. They like to. It's easier to explain many times for them to understand that, okay, I'm going to, and 2x is our target, right? So I'm going to double my money. I'm going to, and that's kind of like what we want to convey to them and solve for. As you know, a lot of assumptions go into solving for an IRR and equity multiple, and the simplest one to manipulate an IRR, and everyone has to be careful with, is the exit cap rate, right? Because you can just move it a few bips or something, and there's others, right? There's rent growth. There's a bunch of things you can manipulate, but that, like, we don't know what the exit cap rate is going to be in 5 years. I don't know what it's going to be. I mean, I'll be honest. So there's the best we can do is kind of try to be conservative with it, but then it's just a projection, right? And it's a way, to your point, to make an apples to apples comparison for an investor to say, okay, so this is this IRR, and then that's that IRR kind of return profile. But it's not really a promise or a guarantee of any sort. It's more of a, it's you know,
It's
we
the P
for the
word.
yeah
Yeah, it's a
yeah
projection, not a guarantee.
it's a projection. There you go. There you
People
go.
think it's so promise, and it's just not, unfortunately.
No, no.
Yeah.
And we really are very upfront about that with our investors because we want to, because we believe that really creates that long-term relationship with, at least with our investor base, that it creates that trust. And we're the first ones to tell them, hey, look, this we think we will hit this IRR. We actually think we're going to outperform it, but we may not, right? So we want that to be clear.
Yeah, you said a lot of really great things here, and kind of the way I break it down simply when I talk to our investors, maybe someone's making their first LP investment and has never really been in this world or been in anything passive. I just say, hey, if you're going to give us $1, our goal is to return, to you $2, and by way of that $2, we're going to give you about 30 cents along the way in cash flow, and then hopefully $1.70 on the exit. Then we can roll into the next deal, ideally, assuming we hit our projections and things of that nature. And I would like to actually double click on another thing you said, which is something that we've been talking about ad nauseum. This is exactly why we want sponsors like you coming to our event, is because we agree in relation to the IRR conversation. When you start seeing people projecting these 25, 30 IRRs, you're accruing a ton of risk. Oftentimes it's probably a shorter debt term. However, when you see these deals that are, called a 14 to a 17, you're noticing a better result there. So I just want to double click on that because it's nice to hear another voice in the space who sees the world and deals similarly, because sometimes we see stuff and they get funded. I'm like, how the heck did people do that and not see maybe the manipulation of the exit cap rate, which is something we harp on, or looking at the expense ratio, seeing rent growth, drastically outperform other costs associated. So it's so funny and refreshing to hear that. But with that said, would you be comfortable sharing kind of some of your stories in relation to how, those deals with lower projections end up outperforming and vice versa? And had that anything to do with kind of quality of real estate as opposed to maybe, something else? How did that all occur, I guess, if you will?
Yeah, so a lot of those deals, it was all personal money that I invested in, and that I was starting to get more comfortable with the industry. Back then, I used to be a developer. I used to develop ground up real estate. We used to build condos and single family home communities in Latin America,
stuff like that.
Yeah, right. So we were making good money. It was pretty transactional, but it was good money, and we were looking for places to place our money, right? And that's how I got into the whole LP thing, right? And how I discovered this multifamily world. So where I was going is a lot of the LP positions that I took that were promising or offering, not promising these or promoting, but let's call it these higher IRRs, had shorter hold periods, shorter debt. I think the shorter hold period was the common theme, because then if you model a deal over 2-3 years and get the same result and exit it with it's obviously your IRR is going to be a lot higher, obviously, than if you model it over 5 years. However, 5 years gives you a lot more time to absorb any unknowns and any risk in the market. So, and it turns out, from my experience, from my small sample, because it is a small sample, there may be other experiences out there. From my small sample of, let's call it 50 LP deals, more or less, what I ended up seeing was that the operators who were saying, yeah, it's a 5-year hold, and I'm not saying we haven't promoted deals that are shorter than a 5-year hold. We try to stay away from it, but yeah, we've done 4 maybe. But we try to do 5 to 7. We try as much. But some deals are a better fit to just go for. But whenever so that shorter hold period was definitely on pro forma, right? Now, what ended up happening was a lot of these other operators who were saying you're going to get a 14 IRR over a 5, 6, 7 year hold. Well, they ended up selling in 3 years or refining or whatever unexpectedly, and that would give us a huge boost to our IRR as an investor. So that was a great learning experience for me, I think, and personally, and I started to appreciate the whole mitigating risk, and it's about your risk adjusted return, because if you do enough of these, they're not all going to go well, and it's more about really balancing it out, and it takes a lot of work to do it well.
Yeah, it's probably great that you had the foundation of investing as an LP because you think like an LP and you've seen people pitch you, you've seen people project stuff, you've learned the trials and tribulations, the good, the bad, and the ugly associated with being an investor. So I think that's a very smart way as you shape your kind of thesis for your company. That said, when it comes to debt structures and processes, from a boilerplate perspective, if you're trying to talk into an LP or a fund manager, some sort of a capital allocator about your base case way of doing stuff, right? What is kind of your sweet spot on an LTV, LTC perspective? And then what type of debt are you kind of looking for in today's market? I mean, you can make the case that floating makes a lot of sense right now.
Hmm.
If you believe rates are, SOFR is going to come down. But a lot of people like the surety and the certainty of fixed rate debt, right? So with that said, what are kind of, how are you sizing up the capital formation for your deals?
Yeah, so on the debt side, it's our preference for the most part is going to be agency debt probably, and that'll probably size up to somewhere around 60% LTV. We make exceptions. With not every deal we do is agency or has been agency. We have stuck more with the fixed rate, but I do agree with you. I'm very intrigued about the going floating, especially if there's a pretty good expectation that that SOFR is going to go down, or the shorter end of the curve, or the Fed funds rate, if you will probably go down. At least in September, it's pretty much. I mean, it's pretty much a given. It looks like the market is saying it'll go down, and when that happens, it's usually the case unless the Fed says otherwise before. So it looks like it's going in that direction finally. So I'm with you. I think that going floating is would be, it's a great time to go floating if it ever is, right? It's a little bit contrarian, right? Which is the funny thing about everything we do. What sometimes the best thing is what's not popular. I'll admit though, we haven't been doing floating, and part of the reason is a lot of our bigger investors are family offices, and they're going to be very risk adverse, right? And we know, and we start talking to them as we are sizing up the debt and whatnot, and we tell them, hey, look, these are the different options we're looking at, but we want to talk to you as well because you're going to invest, right? Or they've demonstrated interest, and maybe they're going to bring half the equity or whatnot, and we hear them, right? And a lot of the times we're like, we understand, we hear you, we believe you, and we actually agree with you, but our mandate is fixed. So we're trying to get them to the other side as well, but we haven't gotten them there yet.
Yeah, and it's kind of funny because people are always like, "Oh, I want to do fixed rate debt," and then they'll also ask, "Hey, hey, I'm a fixed rate debt, investor. I like that." And then they ask, "Hey, if rates go down, are we going to refinance or whatever or sell?" It's like, well, you do.
Or your prepay is gonna, yeah.
Yeah, you realize the cost associated doing that is so prohibitive, you actually don't want to do it whatsoever because
right.
Conversely, if rates go down, the prepayment penalty increases, right? So these things are very fluid in many respects, but investors, seemingly always want it both ways. They want alpha with no risk and, all the upside, if you will. And it's just tough to forecast that. But to your point there, I like kind of the leverage point, and it's very interesting. Historically, at Lone Star, we've done deals that are probably higher on the LTV curve, if you will. But moving forward, kind of our goal is to do 65% LTC, LTV maybe, which means we're almost raising double the amount of equity for our deals, which means although depreciation is back to 100%, those dollars in the deal really do get cut down. So they're not offering as much depreciation, but we want to be in more quality and core assets where you just don't lose money. And kind of in that structure you said, the people that, have good intention to hold it for 5 years, but ideally sell it in 3 or 4 because the market comes back and you can realize your exit and your return structure, at a earlier time. That makes sense. If you're looking to get something and you can get it, don't think about leaving money on the table or, kind of the grass is always greener, cup half full. take that profit and go to the next one. And that's kind of our goal, is potentially be the people that, we're holding it maybe for 5 years on, deals that might project to a 14 to 15 IRR, but we sell it early and we actually have a better return than advertised and expected. So that is ultimately the goal. And by the process of going with lower leverage, you also get more term IO, which is obviously very beneficial. I mean, we've seen a lot of deals that, it's harder to make the deals work, and things get a little bit more razor thin on the margins when you do start to amortize. So that's kind of how we see the world from a debt servicing perspective and kind of a capital formation process as we go forward. We're just wanting to take a little bit more risk off the table and, have a easier time of liquidity for these big funds and institutions to buy up, what we're looking to acquire, which makes their life more difficult on the front end, but an easier for tomorrow, So with that said, I'd be curious to know how deal flow has gone, specifically in the Midwest and the Kansas City market, or the Kansas market, and kind of the Missouri market that we're in right now. What has deal flow been like for the first half of this year, or just this year alone, compared to 2024 and years before?
It's picking up. It's been slow. I mean, we've been buying. I mean, not a ton, but we've been buying at least a deal or two a year over the last 3-4 years. But it's been slow. It's been there's not a ton of transactions going on. There's not we continue to see this bid ask spread. We get a ton of deal flow from our local relationships. And when I say deal flow, they're not all good deals, right? So I mean, we may underwrite them and look at them, but they're just very far off from what we're willing to pay. So we continue to see that bid ask spread that everyone talks about. However, there are exceptions, right? And we can get deals done. We kind of stay in that 100 to 250 unit size space kind of thing, which really in 80s, 90s, maybe 2000s build is kind of like our thing. We do buy 70s, unlike other people.
We'll buy 70s too, if it makes sense.
Yeah. And I think that the reason we're both you guys and us are willing to buy 70s is our hyper local focus, right? That we see things others may not, right? And like in the last 70s deal we bought, first of all, they've invested. A lot of groups are not looking at it just because of the vintage. And I know I'm going off topic here a little bit, but I'll tell you the story. Yeah. So a lot of people are not, just weren't looking at it because of the vintage. It was 1975. They're like, oh yeah, I know this is too old. Blah, 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 the whole story. Well, there's multiple things that we were seeing. First of all, I guess you're going in yield, if you will, or your cap rate, which I don't love to use that word because there's so many ways to skin the cat with cap rate, but let's call it cap rate, right? Your going in cap rate is a lot higher than a comparable property built in the 90s, right? The spread has definitely gone up from 3 years ago or 4 years ago, and it was basically a few bips spread. Well, now you're up to 50, 75, or even 100 bips spread between a 90s built and maybe a 70s built. This specific property was in a great location, 100,000-ish household median income, which is pretty high for Kansas City, great schools in their area, and the previous and the seller had invested over, I think it was $7 to $8 million in capex, so they had replaced all the issues that scare us with the 70s build, like the plumbing, the electric, all that was resolved, right? It was taken care of. So specifically, the location really is what reeled us in, because we love the location of this specific property. And I think that hyper local focus is what really helps us understand how good of a location it is. And it turns out that, well, the fact that it's built in the 70s isn't that much of a big deal because they've addressed the issues that come with properties built in the 70s, or at least most of them, if not all of them.
No, I love that story because similar to us, we bought a 72 vintage deal in Dallas last year, Grand Riviera, for those who may be familiar, which was located between DFW, the fourth busiest airport, not in the country, in the world, and between Las Colinas, which is like, Fortune 500 galore with all the headquarters being there. So you've got people that need to service both those employers there. They're also expanding it. So we know that job base and location, that basis and that, kind of affordability window, you can't make affordable housing like that anymore. You can't basically build anything that's workforce that's, can accommodate tenants of that profile. So this deal, we felt like, hey, this will always have demand because of this location, because it's close to a bus stop, and it also had absurdly large units. Although it's a 70s built property, it had like 300 square feet larger interiors per average door than the property in the comp down the street, which was also a 70s vintage asset that was getting like, a couple $100 more than us. So we just felt like this was a no-brainer. How could you not? Now, some equity is going to shy away from it in today's market, but guess what? When that market does turn around, when the market is hot again, there will be buyers around the corner looking to buy in Dallas and looking to buy a value add deal where they're going to replace the rest of the units and they're going to like their upside there. So we will contextually look at that as well. And we're looking at now an 85 vintage deal in Houston, which has, another wrinkle with an exemption on it. So we are able with our hyper focus as well to you guys be able to decipher what makes sense. And then to kind of go a step further, depending on where you're located, 70s could actually be a newer product, or even 80s. You go to a lot of places and pockets in Phoenix, there's some older places like that. Where in Tempe, that's actually pretty good. If you go to Columbus, Ohio, 70s and 80s, to my knowledge, is actually pretty good. If you go to places maybe in Illinois, that's fine as well. But obviously, if you go to, more urban areas, 70s and 80s is probably the worst product, because there's always building, they're always building something, in the Galleria or downtown Houston or stuff like that. So contextually speaking, it can be a misnomer, but you can find the value there, and you just got to account for the CapEx stuff. But when you hear, that there's a seller that took care of it before, potentially a mom and pop, it was their baby and they love their tenants and they didn't really want to boost up rents, stuff like that creates a perfect storm to make that deal make sense.
Yeah, absolutely.
Yeah.
And so our ideal deal almost has become find that deal in, like the example I was mentioning right now, in a great location with the high median income, good demographics and whatnot, and where there may be development that's going on down the street. It's all Class A, it's not a new build, right? And there's also older inventory, like older product, or smaller in multifamily that's maybe 20, 30 units that doesn't really compete with you because they may not have the amenities, it's older. And it turns out that you're one of the few in that submarket or that pocket of town that can offer rents in, I'll call it 1,200, just to give you an example, where the other older property is maybe not up to standards to a lot of the prospective residents. But the Class A is going for 1,800, 1,900, 2,000, right? So you really end up catering without much competition from a leasing perspective to more the affordability side of things in a great part of town.
Yeah, all makes sense. That said, Bernard, we're going to wrap up the show here. How can people reach out to you to learn more about yourself, investing in the Midwest, and partner with you guys in the future?
Yeah, so our company is ehpcapital.com. You can go to our website, www.ehpcapital.com, and feel free to email me. I'll give you my my direct email. It's Pierson. Pierson is P as in Peter, IERSON, at ehpcapital.com. Just reach out, and I'll be happy to talk to anyone.
Excellent. Well, we're excited I'm excited to see you next week, I should say, and we're excited.
I am too, yeah.
Yeah, part of the channel. We're going to make sure we're going to make a lot of hay and meet a lot of people, shake a lot of hands. But to everyone listening this week, we appreciate you, and we'll see you next week. Peace.
Yeah. Thanks, Greg. Have a good one. Bye.